China just banned the chemical that produces 75% of the world's silver. Most people have no idea this happened. The mainstream financial press was too busy covering oil prices and ceasefire rumors to notice. And while they were looking the other way, three of the most significant signals in the silver market's recent history fired at the same time. This is recession warnings. Today is Saturday, April 19th, 2026, and what I'm going to walk you through in this video is not a routine market update. It is not hype dressed in urgent language. It is a specific, documented, data-supported case for why the silver market right now is sitting at one of the most structurally loaded setups in recent commodity history, and why the price you see on your screen today, $79.28 per ounce, may look completely different by the time this year is over. Before we get into the signals, let me ground you in what the silver market actually looks like right now, because the numbers matter and because they are already telling a story. Silver spot opened this weekend session at approximately $79.28 per ounce. Gold is trading near $4,300, extending its fourth consecutive week of gains. The gold-silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, remains historically elevated. That ratio has historically compressed during the later stages of precious metals bull markets. And when it compresses from current levels, it compresses fast, meaning silver outperforms gold significantly on a percentage basis. That's the setup. Those are the numbers. Now let's talk about what's underneath them. The Silver Institute has confirmed a sixth consecutive year of structural supply deficit for 2026. The deficit this year alone is projected to reach 46.3 million ounces. Since 2021, approximately 762 million troy ounces of silver have been consumed from above-ground stockpiles. To put that in perspective, that approaches a full year of total global mine production, drawn down not from new supply, but from the reserves the market had accumulated over decades. That inventory is gone. It cannot be replaced quickly. And the market has been operating in this deficit condition not for 1 year, not for 2, but for 6 consecutive years running. That is the foundation everything else sits on. Now let's talk about what happened this week that makes this particular moment more urgent than any prior point in that deficit cycle. On Thursday morning, April 16th, 2026, the Shanghai Futures Exchange issued an emergency suspension of silver futures trading. No reopening date was provided at the time of the notice. Most American investors saw nothing about this in their news feeds. If they caught it at all, it was a single line in a commodity roundup. Here is why that single line deserves your complete attention. The Shanghai Futures Exchange is not a minor institution. It is China's primary industrial futures market. It is the pricing mechanism through which the world's largest industrial consumer of silver manages its forward costs for a metal that flows into hundreds of millions of solar panels every year, into the semiconductor supply chain, into the electric vehicle systems that China is producing at a scale that continues to accelerate. When an exchange of that magnitude issues an emergency halt, it is not a cautionary measure deployed against routine volatility. Emergency halts are responses to acute pricing pressure. They are deployed when the bid for physical metal has so overwhelmed available supply that the exchange itself determines ordinary trading cannot continue without the risk of a disorderly outcome. In the plainest possible language, the Shanghai Futures Exchange blew the whistle and said, "The game as it was being played cannot continue." Now add the inventory context that gives that halt its full weight. Chinese silver vault holdings currently stand at approximately 23.3 million ounces. That sounds like a substantial figure until you measure it against China's industrial consumption rate. For solar panel manufacturing alone, to say nothing of electronics, electric vehicles, and the broader semiconductor supply chain, 23.3 million ounces is not a reserve. It is a countdown. And the emergency halt was the exchange communicating in its most formal institutional language that the countdown has reached a critical threshold. The market cannot pretend otherwise anymore. The second signal comes from the CFTC Commitment of Traders report, the weekly data release that shows how major financial institutions are positioned in COMEX silver futures. For decades, large banks maintained substantial net short positions in silver. The logic was straightforward. Short positions act as a structural ceiling. Banks supplied paper contracts against physical demand, absorbing upward price pressure and capping silver rallies. When that short position was large, silver had an institutionally constructed headwind working against it. Here is what the most recent data shows. The bank net short position has been reduced to approximately 23,000 contracts. That is the lowest level since early 2025. At 5,000 ounces per contract, that represents roughly 115 million ounces of short exposure. That sounds significant until you understand the context surrounding it. Earlier in this cycle, institutional banks assembled the largest short position in recorded COMEX history, an unprecedented level of paper short selling designed to cap silver's rally, and silver climbed straight past $100 anyway. The banks built the single largest short position in history, and the market ran through it. That is the central empirical fact of this bull cycle. The entity designed to act as the price ceiling could not hold the ceiling. Now that record short position has been more than half reduced, falling to a multi-year low at exactly the moment when physical signals, technical structure, and supply chain data are all aligned in the same direction. The institutional counterweight has stepped back, the structural headwind has diminished, and the fundamental forces pushing the bid for physical silver have not weakened. They have intensified. Before we get to the third signal, which is the one that has received the least coverage and may ultimately prove to be the most consequential, let me address what happened in broader markets this Friday, because the contrast tells you something important. The dominant headline Friday was oil. Crude fell more than 10% in a single session on reports suggesting Iran had agreed to keep the Strait of Hormuz open during a 10-day ceasefire window. The Dow surged. Risk appetite performed. And in the middle of all of that, silver rose. Read that again carefully. On a day when the dominant narrative was that geopolitical risk was receding, a condition that historically suppresses demand for safe haven assets like precious metals, silver moved higher. Gold crossed $4,350. Both metals advanced with conviction against a tide of apparent good news. When an asset rises in an environment specifically designed to suppress it, the serious investor does not dismiss that as coincidence. He asks, what structural force is powerful enough to overcome narrative gravity? The answer to that question is the third signal, and that third signal involves chemistry. Here is the story that almost nobody in financial media has connected to silver prices. China has announced a ban on sulfuric acid exports, effective next month, projected to run through the remainder of 2026. If you are not familiar with metallurgical processing, that sentence may sound completely unrelated to silver. It is not. It is directly, physically, and consequentially connected to silver supply in a way that cannot be worked around on any short timeline. Here is the connection. The popular image of silver mining involves primary silver operations, mines built specifically to extract silver. That image is largely a myth in terms of where silver actually comes from. Approximately 75% of global silver supply is produced not from dedicated silver mines, but as a byproduct of mining other metals, primarily copper, and to a lesser extent, lead and zinc. Copper mining is the dominant source, and sulfuric acid is the critical chemical input in the hydrometallurgical processing of copper ore. In heap leach copper operations, which represent a major proportion of global copper production across the Americas and elsewhere, sulfuric acid is not an optional reagent. It is the mechanism of extraction. Without it, copper cannot be economically separated from the ore. And when copper extraction stops or falls sharply, the byproduct silver that flows from that process disappears from global supply. There is no substitute available on a 90-day timeline. This is not an operational inefficiency that can be resolved by adjusting a formula or sourcing a different input. It is a physical chemistry constraint. Remove the acid, lose the silver. Now layer in the context that was already in place before this ban was announced. Chile, one of the world's largest copper-producing nations, reported output at a 9-year low as recently as late March 2026. Production was already declining, independent of any chemical input disruption. Supply was already tightening before China made this decision. And into that pre-existing condition of declining output, China has introduced a ban on the primary processing chemical for the metal that produces most of the world's silver as a byproduct. The supply consequences of this decision will not appear in spot markets this week or next. Supply chain effects of this magnitude require weeks to months to fully propagate through the system, but they will propagate. And when they will arrive in a market already running its 6th consecutive year of structural deficit, already having drawn down 762 million ounces from above-ground inventories, already operating with COMEX silver stocks down 40% from their cycle peak, from 531 million ounces to approximately 321 million ounces today. The sulfuric acid ban is a fuse on a charge that was already built. The market has not priced this in yet. The mainstream financial press has not connected China's chemical export decision to silver supply reduction. That connection will be made. When it enters the general investment conversation, the repricing will be significant. Positioning before that narrative lands is precisely what the current price represents as an opportunity. If this is the first time you've seen these three signals connected in one place, this is exactly what recession warnings exist for. We cover the structural stories that the financial press misses until they become obvious to everyone, which is usually too late. Hit subscribe now and make sure you have notifications on, because part 2 of this analysis, where we get into the price targets from the major institutional banks, the geopolitical backdrop that's been misread all week, and the US-Mexico price floor framework that could permanently change silver's risk profile, that drops immediately after this. Let me give you the institutional bank consensus first, and then work through the analytical frameworks that surround it. Bank of America has published a silver price target range of $135 to $139 for this cycle. Citigroup, one of the most active research desks in the commodity space, has published a range of $150 to $170. Capital markets consensus sits between $150 and $160. TD Securities has a target of $118. Deutsche Bank's baseline is $100. Every major institutional research desk on that list has silver above $100 as its expected scenario. The most conservative institutional target represents a 26% gain from today's price of $79. The most aggressive institutional target, Citigroup at $170, represents a gain of more than 114% from where silver trades this weekend. These are not the projections of anonymous internet commentators. These are research outputs produced by analysts operating under compliance oversight, reputational accountability, and risk committee review. When Citigroup's commodity research desk publishes a $170 silver target, they are doing so with the understanding that if they are dramatically wrong, there are professional consequences. That is a different standard than opinion, and the consensus across all of them points in the same direction. Beyond institutional targets, two independent analytical voices are worth your attention specifically because of their track records. Jesse Colombo, whose work at the Bubble Bubble Report has been engaged seriously by professional analysts rather than just retail audiences, has outlined a structural case for $300 to $500 silver over the course of this bull market, contingent on silver clearing the $95 to $100 resistance zone and the $115 to $120 zone above that. Based on current technical structure, both of those levels are a near-term play. Michael Oliver, a veteran analyst with a multi-decade record that includes publicly calling against silver during periods when that was the correct position, has stated a case for $200 to $500 silver by this summer. The weight of Oliver's view comes specifically from its source. This is not a permabull extrapolating from hope. This is someone who has been bearish on silver before and said so on the record. When an analyst with that kind of intellectual honesty makes a call of that magnitude, it warrants a different kind of attention than the same call would from someone who has been bullish without interruption for 20 years. Now, let's address the macro environment, because no commodity trades in isolation from the broader economic backdrop, and the backdrop in April 2026 is specifically favorable for silver in ways that are not dependent on geopolitical resolution. The Federal Reserve is navigating what New York Fed President John Williams acknowledged publicly as a simultaneous condition of growth deceleration and inflation persistence. That is stagflation. Stagflation is one of the most historically favorable macro environments for precious metals, and particularly for silver, which carries both the safe haven properties of gold and the industrial demand characteristics of copper. The dollar index has weakened from near 99 to current levels, producing a direct mechanical tailwind for dollar-denominated commodity prices. When the dollar weakens, the purchasing power of foreign buyers for dollar-denominated assets like silver increases, which supports price. The 10-year Treasury yield sits at levels where real yields, meaning nominal interest rates adjusted for actual experienced inflation, are approaching zero or moving into negative territory. This is critical context for understanding silver's investment case. The standard argument against holding non-yielding assets like silver is that Treasury bonds pay you to wait. When real yields are negative, that argument collapses. You're not being paid to wait. You're losing purchasing power by waiting. The opportunity cost of holding physical silver becomes zero or negative, eliminating what has historically been its most significant competitive disadvantage against interest-bearing alternatives. Let us address the geopolitical situation with more precision than the Friday headlines provided, because precision here matters enormously for understanding where silver prices sit and where they could move. Iran announced this week that the Strait of Hormuz would remain open to commercial shipping during a 10-day ceasefire window. That announcement moved oil down 10% and sent the Dow surging. Here is what was simultaneously true and was not prominently reported. U.S. President Trump confirmed that the American naval blockade remains in full force and will remain so until a comprehensive peace agreement is formally signed. A 2-week ceasefire extension was being considered at the time of those reports. Not agreed upon, not implemented, only discussed as a possibility to allow more negotiating time. The strait remains effectively closed under a dual-layered blockade. The IMF's energy director has warned that even in an optimistic resolution scenario, restoring meaningfully disrupted oil and gas output infrastructure could require up to 2 years. A 10-day ceasefire does not resolve a 2-year infrastructure restoration problem. The downstream consequences of continued disruption are real and documented. Middle Eastern aluminum smelters dependent on maritime raw material imports have been cutting production for weeks. London aluminum prices have reached 4-year highs. 19 jurisdictions globally have implemented export restrictions on energy, fertilizers, and agricultural commodities as a direct response to supply chain pressure from the conflict. 9 Asian economies have introduced policies specifically designed to reduce domestic energy consumption. European analysts have flagged a potential jet fuel shortage within 6 weeks if the Strait situation does not structurally resolve. None of these are silver-specific headlines. Every one of them is the operating environment in which silver is being priced, and every one of them reinforces the urgency of securing domestic, stable, critical mineral supply chains, which brings us to a development that has received almost no coverage, but may prove to be among the most structurally significant of this entire market cycle. Documents from a U.S.-Mexico Critical Minerals Action Plan, connected to Treasury Secretary Scott Bessent's engagement with Mexican finance authorities, outline the development of a new preferential trade framework for critical minerals between the two countries. Within that framework, and this is language that appears explicitly in the documents, price floors supported by government-backed mechanisms are described as part of the architecture for silver. Mexico is one of the world's leading silver-producing nations. Silver is explicitly designated as a critical mineral by the United States government. The action plan describes mutual supply chain resilience mechanisms supported by price floors and sovereign backstop structures. Think carefully about what changes in the investment calculus if 2 sovereign governments, the largest economy in the world and one of the largest silver producers in the world, establish a minimum price below which government intervention is triggered. The nature of downside risk in silver changes permanently. You are no longer holding a commodity exposed to unrestricted volatility in both directions. You are holding an asset with institutionally constructed floor support at the lower end of its range. That floor has not yet been formally announced. The action plan is documented but not yet translated into implemented policy. When it moves from framework to formal execution, the silver market will need to reprice the effective elimination of its lower tail risk. That repricing has not happened. The price you see today reflects a market that is not yet priced in that floor. Now, let me give you the honest risk picture, because this channel does not exist to sell you a narrative. It exists to give you the analytical framework to make your own decisions with clarity about both sides of the trade. The risks here are real, and they deserve direct treatment. A rapid and comprehensive geopolitical resolution, a formal U.S.-Iran peace agreement that genuinely reopens the Strait of Hormuz and collapses energy prices, would ease inflationary pressure, reduce urgency around hard asset positioning, and could produce a silver pullback towards $65 to $70 from current levels. A severe global recession that materially reduces solar installation rates, electric vehicle production volumes, and AI infrastructure build-out would compress industrial silver demand significantly, given that industrial use represents the largest and fastest-growing component of silver consumption. Exchange-level interventions are a real and documented possibility. Emergency margin increases, position limits, delivery rule changes, these have been deployed before in markets under acute physical stress. The Shanghai Halt this week is a demonstration, not a theoretical scenario, that exchange intervention occurs when pricing pressure becomes acute. These risks are genuine. They should not be dismissed. But here is what none of those downside scenarios reverses. The sulfuric acid export ban is a physical chemistry constraint. It does not respond to ceasefire headlines or oil price movements. Correcting the byproduct, silver supply reduction it causes, requires either alternative supply chains or fundamental redesigns of mining processing operations. Those changes are measured in years, not in quarters. The structural deficit that has run for 6 consecutive years does not refill on the back of a peace agreement or a single quarter of reduced industrial demand. The 40% decline in COMEX silver inventories from 531 million to 321 million ounces does not reverse in a month. The U.S.-Mexico price floor framework does not disappear because crude oil fell 11% on a Friday afternoon. The fundamental architecture of this market's supply-demand condition was not built by this week's headlines and cannot be dismantled by them either. What I want to leave you with is a specific and honest framing of what the current silver price represents in April of 2026. 3 structural signals fired simultaneously this week. The Shanghai Futures Exchange issued an emergency trading halt with no reopening date. The institutional short position that once acted as a structural ceiling fell to its lowest level in over a year, after having already failed to stop silver's advance past $100 even at its historical peak. And the United States and Mexico began formally documenting a government-backed price floor for the world's most industrially critical precious metal. Each of these individually would warrant serious attention from anyone paying close attention to commodity markets. Their simultaneous occurrence against the backdrop of a 6-year structural supply deficit, a chemical export ban with direct and unresolvable short-term consequences for byproduct silver supply, and a macro environment defined by dollar weakness, real yield compression and stagflationary pressure is the kind of convergence that does not present itself frequently. The mainstream financial press has not yet connected these dots. When they do, the repricing will not wait for you to catch up. The sulfuric acid story has not been priced in. The US-Mexico price floor framework has not been priced in. The full supply consequence of China's chemical export ban has not been priced in. Those three factors alone represent repricing events that are coming independent of sentiment, independent of ceasefire language, and independent of what oil does on any given Friday. The investor who understands the connection between a chemical export ban and a supply chain that feeds a 6-year structural deficit market is operating with information that the broader market has not yet processed. That gap between what is known and what is priced is where opportunity lives. And right now, that gap is measurable, documented, and open. Now, I want to hear from you in the comments below, because the thinking that happens in this community is part of what makes it worth building. Where do you see silver by December 31st, 2026? Is $100 your conservative floor? Are you targeting $150 based on the institutional consensus? Are you watching the sulfuric acid ban as the primary catalyst? Or is there a risk factor in this picture that you think deserves more weight than we gave it today? The comment section at Recession Warnings is not a place for noise. It is a place for serious thinking on serious topics, and I read every response. Tell me where your analysis lands, and as always, everything discussed here is for education and analytical discussion only. This is not personal financial advice. The goal of this channel is to give you the frameworks, the data, and the structural context to make your own informed decisions with your own capital and your own risk tolerance. That is what Recession Warnings is here to do. We will see you in the next one.